Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. It's great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do need to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you'd like, but that's the main point to take away. Other than that, we have lots of exciting topics to discuss for this session. We have a live event that Rob's going to discuss coming up that we're excited about. Really interested to hear Rob's thoughts on Palantir and with the market manipulation accusations and how it's down 7% from that. And our good earnings now bad? That's the golden question, $1 million question, if you will. So lots of exciting topics to get into, as I said. Without further ado, let's kick off. Rob, you out there?
I am Zach. How are you, everybody? Welcome to this week's Trade Finder. Hope everybody enjoyed a fun holiday weekend. As you said, Zach, lots to talk about. Taking a look at the chart of the S&P, just making sure everybody can see my screen okay. Can you?
Yes, sir.
Okay. I was getting my camera view in the blocks, so just making sure I was having trouble with Zoom earlier. Man, companies do updates and messes everything up. But here's the chart of the SPY. In last week's Trade Finder, we talked about how we didn't do an official idea. We just did a post that perhaps buying puts on the S&P might be a good thing with this vertical move. We've retraced all of that now. You can see the high of the day touch the 10-day moving average, but we're down from there. The futures are down 76 at this point. So the key today is going to be, can we hold this area here at 675? And I'm always hesitant to say this because I know more people make money when the market goes up, but boy, I would like to see that 675 level get broken and get a little bit further of a correction in the US market update. We talked about that was a nice move. It hit our zigzag target, but could it hold? And we'll see. 675 is the line in the sand. If it drops below there, there is a ton of congestion here, so we could come all the way down towards 660. But talking about the directional trading and the fact that I wouldn't mind seeing a little bit more of a corrective move. And just to be clear, I'm not calling for any sort of a big crash, but it'd be nice to see about a 5% pullback. I think it'd be healthy, actually, in the market from this really long wave three that we've had. A lot of you signed up for our event we did on trading for income, where we talked about strategies that professional money managers have as a good base for their trading portfolios. And then you allocate a particular part for directional trading. So the professional money managers have both. So we did that. We actually did it twice. A lot of you watched it. I wanted to alert you to, Zach mentioned it briefly in the beginning. We do have another event coming up, also free, called Predictive Trading. So if Zach could put that link in the screen, if you haven't done that already in the Q&A, it's going to be Tuesday night, so it's free. Is that tonight, Zach, or is it next week? Sorry, I'm not clear on the date.
It's going to be next Tuesday, the 11th.
Next Tuesday. Okay, next Tuesday, the 11th. And so that's going to be focused on how AI helps with directional trading. So you'll have both. And that's what we're trying to do, is just get as much education out as we can. So we did the base, trading for income, having strategies that are not directionally based, that are just designed to bring income in while you're trading directionally. Nobody's right all the time on trading directionally, but we all know that when you get a direction right, that's the greatest amount of profits that you can make. So we're going to fill in the other void here with this predictive trading event. And we're actually going to have JP Drysdale from Hub is going to be there, who is the head of the company that produces this software, that also has the data scientists on staff that do all the AI. So you can imagine the amount of information that you're going to get from that. Even if you can't attend live, you would want to sign up so that you can get the recording. He doesn't do very many events, and so this is an opportunity to literally hear from the guy that's created all this software. And Stephen Camp, it's going to be a great event, so please sign up. All right, so back for the do yourself a favor, give yourself a Christmas present. It's free. Those are the best Christmas presents, aren't they? So when we take a look at this 675, what I was mentioning before is the next line in the sand is down here at 660, but you can see all this congestion in here. So it could be a rocky road moving lower, or perhaps 675 does hold. It was the top of that ascending triangle that we broke out of. You know my rules. I don't like things to go vertical. What goes vertically up oftentimes come vertically back down. You get too far from the 10-day moving average, you're going to come back down to it at some point or go sideways and allow it to catch up. One of those two things is going to happen. And I don't like gaps, especially when we have gaps in the S&P or the DIA. Those oftentimes get filled a lot quicker. Gaps on regular stocks get filled, but sometimes they can take a while. Sometimes they can take a while on the S&P as well. But the data shows the majority of gaps get filled. Not all of them, but the majority do. And it's always something to keep in mind. And I didn't like the fact that we had back-to-back gaps to the upside. We hit that 690 level, exactly what we called. You can go back and look at the U.S. market update recordings. That's where we said we were going to go. So we got that one right. It's nice when you get it right. And then we said, well, can it hold? And I feel like the least we're going to do is churn a little bit here. But if we don't hold 675, we're probably coming down a little bit lower. And last note here on the SPY, notice the 50-day moving average down here close to that 660 level. So we could kind of work our way down to that support area or at least test the 50-day moving average. Again, with all this congestion in here, the market could find a bottom anywhere in here, even if it breaks down below 675. So as I've been saying over the past couple of weeks, we got to watch the close. Let's see where the market closes today, and we'll go from there. Looking at the VIX, we still have this big, huge triangle here. The bigger triangle is drawn from the weekly chart of the VIX. We had the smaller triangle back over here that we talked about, a descending triangle. Another rule that I try to talk about as much as possible, descending triangle, contrary to what you may read out there on the internet, does not mean you're going to get a downside breakout. There's some education that says it's going to move in the horizontal line, which is the base here, which would imply a downside breakout. Any triangle can break either direction, and it doesn't matter whether it's ascending, descending, or symmetrical. I feel like I've probably done as much work as anyone on triangles, and I can tell you over nearly 30 years, that's what the data shows. So people can say what they want, but you got to be prepared for a breakout either way. So we had this upside breakout from the smaller triangle, and it hit the upper trend line here of a larger VIX triangle. And then this trend line here, this one right through here, is showing an ever so slight, it's not anything of significance, admit that, but ever so slight higher lows on the VIX. So is that indicating that we could have another bit of a volatility spike? I think you have to keep that as a likely potential unless we can break below this 15 level. If we can break below 15, then the VIX likely works its way back down to this next support line at 12.5, which goes back to last summer that I've highlighted a number of times in the past. And Zach brought up Palantir, so let's just jump at that real quick. I figured that's probably going to be in the Q&A anyway. I mentioned yesterday to our webinar for our Evo Trader Alert subscribers during our live show yesterday that, boy, Palantir was going to have to nail it with their valuation. We had the run up into earnings. It got a little bit vertical. So for that stock to go higher, they were just going to have to absolutely blow it out of the water. And they, granted, had a great earnings report. It was really good. And the guidance was was very positive as well. And initially after hours, the stock did move higher. And then throughout the evening, the market, it reversed and went to the downside. We opened lower. We're trading right here on the 10-day moving average. You know the rule about triangles, or you should by now if you've been watching. If you're new, when you have a triangle and it breaks out, one of the rules is that you come back to test the point of the breakout. We got awfully close to that. We didn't quite today. Maybe there's a little more of a drift down in Palantir. But if it can hold here above the 190 level, it also got above 200, the big round number. And it's not saying anything negative about Palantir. They have huge government contracts. They're executing extremely well. It's a media favorite, but the point is, it's very, very high valued, extremely high, 85 times. And it's just way above the norms, which are in the 20s. So that gives you a reference of what it's going to take to get Palantir to take out this wave five and move into a new impulsive pattern. I think some backing and filling is probably warranted here. We'll see if we make it down to the point of the triangle all the way or to the 50-day moving average, or if we hold here above 190, which would be an amazing show of strength, in my opinion. So today's move has nothing to do with the earnings being viewed negatively, the outlook. I've been talking during this earnings season. I felt like it was going to be more volatile earnings season than the past two quarters, that the ones that come through are going to be rewarded. The ones that don't are going to be taken behind the woodshed. The old expression that my grandmother gave me. You knew if you were going behind the woodshed, you were about to get a whipping. So that's where that expression comes from. So many people always say, what does that mean? Well, that's what it means. The stock takes a whipping, basically, when I say that. And Palantir is not necessarily taking a whipping, but it did get too vertical into earnings. The anticipation was really high. They delivered, but at some point, valuations matter. They just do. And Palantir could stay extremely valued for quite some time, but not in the stratosphere. Right? It's not going to set a new bar for this. It always matters in the end, but in the short term, things can get overvalued or undervalued, but normally it reverts back somewhere towards the mean. We take a look at the metals. Here's an example. We had that unbelievable run in GLD in gold, and we took off to the upside here. And once again, we got too vertical. We got too far from the 10-day moving average. What goes vertically up oftentimes comes vertically back down. We have a wave four that's trying to hold here right at the 38.2% fib level. The 50-day moving average isn't much lower, though. Perhaps GLD and gold come down and test the 50-day moving average. That'd be about a 50% correction. Nothing wrong with that. That doesn't mean that the run in gold is over. It's just going through, again, a healthy corrective phase. And that's important that stocks do that. The further they go into an overvalued scenario, the more volatile the correction is likely to be. And at this point, it's just a standard correction in GLD. Nothing nefarious going on there. And you look at silver, and you can see with silver pretty much doing the same thing. It kind of got almost as vertical as GLD, not quite as much, but almost, and doing the same thing, coming back down. That wave four is right at that 38.2% fib level, a little closer to the 50-day moving average here, but we are below the 10-day moving average on both the metals. And if you're just itching to get back in or looking for a new entry of some kind into the metals, let's just be a little more patient and let it get back above the 10-day moving average. It's not going to be that much of a move. And at this point in time, we don't know exactly where the wave four bottoms will be. Perhaps they hold here. The wave four here is labeled green, which means that wave four is still active, and we could potentially make another low. That's all the software is saying, is we're not convinced that the wave four is complete yet. Maybe it is, but we don't know that yet, or the algorithm doesn't feel that way yet. And so I'd keep an eye on the metals because this is a very healthy correction. And at some point, with the Fed moving into an easing policy, we'll probably get another run back up. But as we showed in the U.S. market update, which comes from the same data scientists, the Fed liquidity chart, and I felt like Chairman Powell was a little bit misleading. Other people have said that they heard it differently. You know, we all hear things in our own way. When he did an interview a couple weeks ago, I felt like he acted, or the comments that he made, they're wrapping up their withdrawal or shrinking of their balance sheet, which is taking liquidity out of the system. But then it comes out in the FOMC meeting. One said that that December rate cut is not guaranteed in any way, shape, or form, even though the market's priced it in. But he also said they'll complete the shrinking of their balance sheet around the beginning of December. So we've got the rest of the month of November where we're going to, I think, struggle. I think that leads into a potential further drift lower or at least churning in the market. But then when the Fed starts re-injecting liquidity back after they complete their shrinkage in the beginning of December, that could be the point when the metals take back off to the upside. That would be very logical and would make a lot of sense. And then I always like to say the market doesn't always do things that make sense, but that would make a lot of sense. So maybe some more channeling here, even a slight drift lower in the metals. But once we get to December, if we don't get a bid before then, we could see a move there. So I would keep an eye on the metals if you're looking for an entry. I'd just be a little bit patient right now, and again, wait for them to get back above the 10-day moving average. I think that would be a smart thing to do. Going to the bond market, we've had this move down once again. Triangle rules. Pardon me. If you've been watching, you know, just shrink this up real quick for those that may be viewing for the first time. That's all the bond market has been doing this entire year is consolidating. Look at all these triangles everywhere. Any sort of a directional move has just been the breakout of the triangle, and then it's gone right back into forming a new triangle. So all in all, really haven't done much. We've had consolidation, breakouts, and then when you look where we are, we're basically back where we were at the end of last year on the TLT. Look at that. Exact same spot we were back in December of last year. So if the Fed re-injects, and I think the bond market had a bid, and as a reminder, TLT is prices on the 20-year. Prices and yields move inversely. So as prices were going up, yields were going down in anticipation of that Fed rate cut for October, which they did give us, but then kind of pulled the rug out as far as a potential cut in December. We don't know that yet. And so prices came down, yields and rates went back up, but we also did the rule or followed through with the rule, triangles break out and come back down and test the point of the breakout. And we've done that, and we're hovering around the 50-day moving average, a little below the 10, getting just a slight bounce up in prices and a slight move down in yields and rates now. And you could get a double whammy in December for the metals if the Fed does come through with their rate cut and they're injecting liquidity. You could see another big run in the metals. I know a lot of you like to look at TNX, so it's going to be the same thing the opposite way because TNX does show rates on the 10-year. So again, emphasizing TLT is prices on the 20-year, TNX is rates on the 10-year. So rates have been going back up. It had its own triangle, kind of the same pattern for this year. It broke down. So that was when rates were going down, and then rates back up, and we've come back to the point of the triangle. So no harm, no foul, right back to the point on the bond market. And once again, kind of probably going to have some choppiness here, maybe slightly down between now and December. But a Fed rate cut, if it comes in December, along with some re-injecting of liquidity, and you could see again a run in the metals, and maybe that's what the current cryptocurrency market needs. I talked about this, kind of got this one right too, that we needed to hold 60 on BITB, one of the ETFs for Bitcoin. I know a lot of you like IBIT. They move very similarly. They're both liquid. Um, but if we didn't hold 60, we'd probably see 55 pretty quick. And that's exactly where we are. So we've moved back down here. Um, Likely that wave five is finished. Also following with LA wave rules, when a wave five ends, you retrace back to the previous four if the wave five did not extend beyond 100%. It didn't, so you look for a retracement back to the previous four, exactly where we are. At this point, maybe we get a little bit of bouncing here out of the crypto space, and then if we do get some more liquidity coming back in the beginning of December, that could set the crypto market back on another run. But for now, we just want to see 55 hold. If 55 doesn't hold, just to give the other side here, then it gets a little bit dicey in the crypto world. You can see this run from the April low up to 55 was quite vertical. And if we don't hold this area, and we're a little bit oversold here from the 10-day moving average, so I would expect 55 to try and hold right in here. But if by chance it didn't, then we could see more significance. Not quite a Katie bar the door, Zach, but the next move would very likely have BITB seeing 45. And I know people in the crypto space don't want to hear that, but that's a distinct possibility. So let's hope we hold 55. We couldn't hold 60. We tried really hard, and then it broke. And now we're going to set things up again and see if we can hold at 55. Like I said, I would think we might get a little bit of a short-term bounce here because of 55 adding some support, but we'll see. And then there's the break to the downside out of the descending triangle in Ethereum, at least as evidenced by the ETHW. Again, another ETF for the crypto world, this time for Ethereum. And I kind of drew this because you could have made an argument that that was the support line on the descending triangle, or you could make an argument down here at 25. So I was voicing that between 25 and 27 and a half on the ETHW is a bit of a corridor of potential support. You can see this uh, congestion right here in early July, which is exactly where we are now. And that could hold. We're below the 10-day moving average here in Ethereum. So perhaps we get a little bit of a bounce, but Ethereum has the same situation as BITB does or Bitcoin, where if we don't hold here at 25, once again, see how vertical that move was up from 20 to 25? If we can't hold 25 here, then we could get a further move down all the way to 20 on the ETHW. So both of them are a little bit oversold at this moment. So maybe at least some backing and filling to the upside this time. We're usually talking about backing and filling to the downside. But backing just means moving back the opposite direction, and filling can be filling any sort of gaps that may have occurred, like on the SPY chart. So at least maybe a short-term day or two bounce in the crypto space, and then we monitor those support levels to see if they can hold or not. Looking at the dollar, we did get a bit of a bid in the dollar. Don't want to see this go too much further. You've heard me talking about the Goldilocks channel here all the way since April. That's an ideal area for the dollar in that it's a little bit lower, helps companies with the exchange rate that have international commerce, which most companies do now because we're global economy these days. But if the dollar goes too high, then that currency exchange rate starts to hurt. There were one or two companies that announced it. I think that's kind of an excuse because we've been kind of hanging around in the lower end for a while. So I don't think that's a very valid excuse, but it could be next quarter if the dollar does continue to the upside. So we've made it up to 100 here, a little bit above the 10-day moving average. So maybe the bond market calms down, maybe the dollar calms down, but I don't want to see this 100 level broken personally, but it could. There is a zigzag here. You can see very qualified and now confirmed with the taking out of the A wave high. And with the tricky part here is the B wave is kind of right in between the 38.2% fib level, which would give you the expectation of 61.8 on the C wave extension. We're there, but it's past 38.2. It didn't quite make it to 50. If the B wave corrects 50%, then you look for 100% extension. So a little tricky here on whether or not we can hold 100 as the high on the dollar. But if we break above that, well, then we kind of know the answer. We're going up here to the 100% C wave extension on the zigzag, and perhaps following the fact that this wave 5 was finished and going back to the previous 4, note that that 100% extension kind of coincides with where the previous 4 was. And that could happen in the month of November. As the Fed continues to shrink their balance sheet and withdraw liquidity, we could see that continue to support the dollar, and we could get that last extension to the upside. We have to take into account that that has a decent probability of occurring. Nothing's 100%. I'd hate to see it happen, but it could. But then it really starts to get concerning if we were to break above that and start a new impulsive pattern to the upside. And as a quick reminder, with Elliott wave rules, every impulsive pattern starts with a zigzag. Every single 5-wave pattern starts with a zigzag. So we have one. I don't want this to be a 5-wave pattern higher in the dollar, but the market doesn't care what I would like. Couldn't give 2 cents on my opinion, but anyway, those are my thoughts on the dollar. And then we go to energy, and there's been some positive over the past couple of days on the financial networks, and it's it's pretty easy to see. We finally had a little bit of a bid under natural gas. As you know, we with UNG had a quick trade here that we got fortunate on. I've been opining for a while that all these rips in UNG sell the rips. We're in buy the dip program mode in the equities markets, but the opposite of that is sell the rips. They like to rhyme everything. Buy the dips, sell the rips. So every time natural gas went up, the sellers came in, sold it back down. We did build a pretty good base here around 12 and a half, and we got a bid now in natural gas. We're pulling back a little bit today, but if I spread the chart out, you can see that there's the move higher. And I was looking back in here, all the way back in this area for a potential, at least just oversold bounce or an exhaustion of sellers. At some point in time, the sellers take a break, and they haven't yet. So we're kind of at that same high that we were when we took off our trade, and we were fortunate to do that day, even though I felt like 15 was going to come up. We had a profitable trade, and it's just like take the gain while it's there. When natural gas has been so tricky, and I've basically been wrong on when the sellers were going to get exhausted, but maybe they are now. And with some of the positive commentary on natural gas over the past couple of days, perhaps that keeps the bid and we do make it up to 15. Then I have no idea where we go on natural gas. That's the next point of resistance. Looking at oil, not much else to say there. I keep saying, Zach, we've got to get that sound clip of Song Remains the Same from Led Zeppelin anytime we show natural gas because back at the beginning of the year when we did the market outlook, one of the things that was in the outlook for this year is oil I felt was going to stay in a trading range all year because I think OPEC's done a really good job of managing the supply demand curve. That's the issue with natural gas. We have so much supply. Are we going to get the demand? We had some people come from electric companies saying there's plenty of electricity for these data centers that are going to be built. But then there's been some positive comments on, yeah, but natural gas is cheaper. And even though there may be the electric capacity for them, the data centers may choose to go with natural gas because it's less expensive than electricity. Pretty valid argument there, I would say. But notice here, what's interesting with oil is we broke from the one triangle. It was a large one, and now we have another one. So we have a small triangle formed here on USO. Uh, the triangles are tricky. We did have a strangle on USO and thought maybe we might bank it down to 65. But once again, we timed our exit pretty well um, because my concern on oil going all the way down there is would OPEC let it go down? I've talked about how well they've been managing the supply demand curve situation with oil. They don't want oil to get too low because they know they have a limited supply. They're diversifying into other things. I was doing some reading last weekend about Saudi Arabia and their investment fund and all the things, and they've diversified. 50% of their portfolio is now no longer tied to the price of oil. They know they have a limited amount. They've done the geological surveys, but they want to keep the price elevated as much as they can without scaring people away from gas-powered vehicles and bringing another run into electric vehicles. So they want to keep it elevated, but not out of control. And we seem to be okay with the prices at the pump now. And so that's why, in my opinion, OPEC just likes to manage it right in this area for where it goes. So my point was we exited, we had a profit. So once again, we took it on the move to the downside. Even though I felt like we could come down here towards 65 in that area, but we took it while the profit was there because my concern was at any time with the price of oil going down, OPEC could come in and cut production, and that would certainly put a back into oil. They didn't do that, to my knowledge, but we got the bounce anyway. And once again, right back to test the point of the triangle breakout. So these rules that we talk about, hopefully people incorporate those into their trading plans. All I'm trying to do here is I'm not trying to say I'm the world's greatest trader. I'm not. I'm wrong a lot. But I do have a lot of experience. I've been doing this a very long time. And some of these little rules that I talk about week in and week out work. And regardless of what trading system you're using, I think they're rules that should be in everyone's trading repertoire. And it's simple as that. And it's just my opinion. In my experience, you can listen or not. You know, obviously you're in control of your own accounts. You can make your own decisions. So my long-winded point here is it is another triangle. We're probably going to break out. I don't know if this one's big enough to yield enough of a breakout move to have a successful strangle. I'll look at it probably this afternoon, maybe tomorrow, and see. But my suspicion is even if we break out of this triangle, I don't know that it'll be enough of a move to generate enough return to make it worth the risk of putting any position on, in this case, a strangle, where time decay is the enemy on both sides. Put and call that you're buying. But I do feel like we'll get some sort of a move here, and we'll watch that and see how it plays out. Looking at the rest of the markets, looking at the DIA, they're all going to look pretty similar. We've had a little bit of a pullback. We didn't get quite the same vertical move, almost the as the SPY, but not quite as much. But we still had the gaps, which is even more unusual on the DIA than on the SPY. And so we've come back down Now we'll see if we can hold right where we are here. So this would be like that 675 level on the SPY, 470 on the DIA, and same scenario here. If we don't hold 470, all this congestion, just like we had on the SPY and the 50-day moving average right here, maybe all we're doing, which is very normal in trending moves, is you periodically test the 50-day moving average. It's just normal, nothing unusual about it. If you break below that, that's when you start to get concerned about maybe there's a larger correction on the horizon. But for now, we just all we've done so far is recover the vertical move where we got a little bit overbought in all the markets. We're back holding this area. Can it continue to hold it? Do we need to test the 50-day moving average? So we're in an area here where you want to be a stock picker. Pick your individual stocks. It's a stock picker's market, as they say at this point, rather than just buy the ETF and hold it. More emphasis now, and so we sign up for that. Webinar that we have coming up on predicting movements, and it'll help you to identify where the individual opportunities are rather than just blanketly looking at an ETF that follows the market. And we had a little bit of a lag here on the Qs. They were kind of holding in there. They had the same run with the same gap ups. So we got vertical right to the 100% extension on this zigzag pattern. And as note, that was in the area of 38.2. So 61.8 was the initial target. And as I try to say a lot with zigzags, if they're in the wave three, those are the ones that have a higher percentage of going to the next fib level. In other words, what's known as an extended C wave in the zigzag. And we've done that. And then when you start looking at going to the second extension, it does happen, but it's a small, very small percentage of the time, even in a wave three, that a zigzag goes to its target, then an extended level, and then a second extended level. So I've seen it happen. It's just a small percentage of the time. So maybe we hold here for a while. Once again, you want to see it get back above the 10-day moving average, but it looks to me like the Qs want to come down to 610. There's an area of support there. We get all of this vertical move back, which we've done on the SPY. We haven't done it on the Qs yet. So they're lagging in this little bit of a corrective phase that we're in. And then we can fill those gaps and then maybe hold support there. But just like the other markets, if we break that a little bit lower is the 50-day moving average. I don't know if the Qs get down that far, but if they don't hold 610, then I would say there's a much higher percentage chance that we test the 50-day moving average. And then the IWM, which you would expect when rates were going down in anticipation of the October Fed meeting, it was keeping a bid under the IWM, even in the face of knowing that the economy was slowing a bit. Jobless claims were moving up, all those things going on. But with rates down, I've talked about this a lot as well. The IWM, the Russell, is the most rate sensitive of all the markets because they're smaller companies that need to borrow money when rates are lower. It gives them the opportunity to do that. And then they tend to shy away from borrowing money when rates are higher. And so now as rates have ticked up, that's erased some of that bid that was holding the IWM higher. Notice it's now the first market that has actually officially tested the 50-day moving average. So is the IWM, there were some people earlier in the year, a few months ago, that were saying they liked the Russell more than the rest of the markets, even the Qs. A lot of that was because of the valuations in the Qs, as we talked about with Palantir. But maybe the Russell is going to lead us back up. I think we need to see the rates turn back around and head lower. And again, we don't really know for sure that that's going to happen, at least if the Fed is being honest about they're going to continue to withdraw liquidity until we get to the beginning of December. Um, if they start injecting liquidity sooner, I think you'll see it evidenced by the IWM rather quickly. So I guess my point here is, since we still have a few weeks to go here in November, can this 50-day moving average hold? If it does and we bounce, you got to get back above 245. So if you're itching to get in the IWM, and you're like, oh, we're testing the 50-day moving average. Yep, that's good. That happens a lot. Oftentimes it acts as support, but the next resistance level, it was support there for a while, as you can see, is 245. So once again, exercise patience, let it get back above 245 and the 10-day moving average. So that's kind of the theme on the markets. Let them all get back above the 10-day moving average before you step in. The old expression, trying to catch a falling knife, is what you're doing. And that's usually a phrase that's used when the market's going through a big downward move. So you have a big downward move, and people step in and try to figure out where the bottom's going to be. Very difficult thing to do. It's more prudent just to let the market tell you where the bottom is and then step in, especially on the directional trading side. All right, so I think I covered everything, Zach. I've run a little bit longer than I wanted. I do have a good, what I think is a well set up case study consideration. It will be an official idea. We'll do that at the very end, but for now, let's take as many questions between now and then as we can.
Sounds like a plan, Rob. We'll get right into it. First one is going to be symbol RANI.
RANI. Man, I say this every single week, but this TradeFinder show is my favorite show that we do, and we do lots of them throughout the week for the subscribers, etc. Because you guys ask questions on stocks that aren't the norm. So this is therapeutics, and it is giving a good example of some of the rules that I went through. I don't know what happened here. Maybe they have some drug or something that got approved or was showing good results in the phase 3, whatever, because all of a sudden we went from 50 cents to above 350. But that's that vertical stuff again. And I know it gets the headlines. People want to chase all that stuff. And it's just never a smart thing to do, because what goes vertically up, you know the rules, comes vertically back down too far from the 10-day moving average is a really good example of the rules that I've highlighted. Now, the question is, can it hold this $2 level? That's what you want to watch. So if you're in this, at this point, I don't see a reason to get out because it's trying to hold $2. It did the corrective part. It got down to the 10-day moving average. It retraced a lot of that vertical stuff that occurred. But $2 is going to be the key, not just from a support level, but there's the 10-day moving average as well. If it breaks down below 2, then watch out. A lot of this entire move could get retraced. We could go back to $1 where the 50-day moving average is, or we could hold in here, and I would have to go back to give a better dissertation on this and see what it was that the market liked on this move, and then see if that's something that is long term. Did they get a drug approved? That would be something that's different than phase 3 trials. Just so you know, in the drug area, phase 3 is the last phase. That's when they're actually testing on humans. And if it shows results, then they start kind of opining on whether or not it's going to be officially approved by the FDA, whoever. And if it's something that is shown great promise in phase 3 trials, then we still have to get official approval. If it's a drug that got approved already, then I would say 2 could very well hold, and then you start a more normalized run higher, not this crazy stuff that occurs when things go vertically. I know if you're in it at the time, you're like, that was great. I made a bunch of money, but hopefully you got out because otherwise you gave most of it back. And that's the issue when you get these big vertical moves. So watch the $2 level, and I really can't say anything more about it without looking into what caused that move.
Very well. Thanks, Rob. From there, let's go to SMCI. Lots of requests for that.
Yeah, it's one of my favorites as well. So I think I've mentioned that a few times here in this show. Um, I think this could be one of our subscribers, Maria, had posed the question about a month or so ago now, maybe even a little bit longer than that. Read about performance chasing. And just as a quick reminder for those of you that are new, money managers, yes, they earn a big salary, but their big money comes from bonuses at the end of the year. And to achieve your bonus, you have to beat the S&P. That's how it works. And statistics have shown that a lot of money managers have not performed as well as the SPY, especially if they weren't in those big tech stocks that have been driving it. We know a good part of the SPY, even though it's 500 stocks, has been driven by 10 stocks. So if they weren't involved in those from valuations or whatever, they're underperforming. So what ends up happening towards the end of the year is those money managers look for, all right, where are the stocks that have underperformed everything else, and I can get a better bang for my buck if I'm in those at that point in time. I think SMCI could be one of those. It was the darling for a while, and they got added into the SPY, and then they went through all their accounting issues, and it just crushed the bid that was underneath. And so now we've been kind of chopping around here. And then there's the 50-day moving average here. The drop today would be a little concerning unless this B wave holds. So just back to the rules of zigzags. We can test the B wave. That's not unusual. It's right at a 61.8% fib level, which is a strong fib level. So the positive is it could hold here. The negative is we're below the 10 and 50-day moving averages. So if you're in it, I'd stay in it unless we break this B level. And then based on zigzag rules, we're likely coming all the way back down here to the 0 point. So there would be more downside to go. So it needs to hold right here, right now. Another song. We just need to have like a music board, Zach, where we press the buttons when borrow these phrases. Listen to a lot of music, so I guess that's where all those phrases come from. But if you're looking to get in, once again, I think I'd be a little patient, letting it back above the 10-day moving average. This is too perilous right here at this B. It's got to hold that, or we eventually work our way. We may bounce a little bit at 45. There's support there, but based on zigzag rules, you'd be coming all the way back down here. So we got to keep an eye on that one. But if it can hold here and get back above the 10-day moving average, that's one that could perform well into the end of the year.
Next, let's go to CDE.
A mining stock. Is this crypto mining? Is this gold, silver? Not too familiar with exactly what they do. But that is one ugly chart. There's the catching of the falling knife scenario right there. That's a pretty good example of what I was talking about. It had a nice run up. Really wasn't that bad. It was a little higher degree than 45, a little more in a 45-degree angle. And then it had the last little vertical move. But that should have been taken care of right through here. And yet it's broken down again. So we've got a negative 1030 cross there. We're below the 50-day moving average. The best thing about this stock is that it's at a 50% correction. And we have labeled the wave 4. Maybe that's the end of it. You could look at this one for a bit of a bounce back up to the upside here because it's too far from the 10-day moving average. That doesn't mean that we're done and off to the races again, but it seems a little oversold right now, and we could get a bounce back up towards that 50-day moving average. Just to give you an example of what I'm talking about, when these get it extreme, Amazon, I don't know if it's going to get asked about or not, but personally, I after that second move yesterday, I bought puts on Amazon because of this very nature. Too far, too fast, vertical gaps up, and you look for a 1 to 3 day trade. That's it. Not looking to stay all the way back down here. When you get into an extreme overbought or oversold condition, there's a quick retracement. Sometimes it's only 1 day, and it rarely goes beyond three before it starts to level out. So that's I'm in that right now, and we'll be watching Amazon into the close. May take it off before the close today, or may hang in a little bit longer, but it'll depend on where the close is. But it's a perfect example. So we have the exact opposite on that core, or however you pronounce it, mining. So it works both ways, is my point. When you get a vertical move too much one direction, you get that 1 to 3 day opportunity back towards the opposite direction. All right, I'll stop talking, keep going, Zach.
No worries. And that's Coer CDs and the precious metal space, just for context.
Okay, well that's all right. That ties into all the rare earth, all that got lumped together with all that stuff between the U.S. and China. And I think some of the selling in that space is overdone. So I'd keep an eye on that one. Um, yeah.
Very well. UNH.
I haven't looked at that one in a while either. And interesting that you bring this up, because it's in the same sector as what I'm going to give out as the case study consideration today. Slightly different chart, but we know about all the problems that UNH had. I don't need to rehash all that. The bottom line here, I'll try to be a little bit more succinct, is that we've come back down, got a wave four right at the 38.2% fib level. We're below the 10 and 50-day moving averages. There's really good support in here. Boy, if you were super aggressive, you could take a shot to see if that holds, based on the fact that there's so much support right in this area. But the more prudent thing to do would be, as I've been talking about all session long, it seems, is to be patient, let it get back above the 10-day moving average. Then maybe UNH continues its run back to the upside. But this area of fib level is of interest. It's not as strong as 61.8, but 38.2 is the next strongest, in my opinion. And then there's a ton of support right here. So, yeah, that one kind of goes into, we all have our own risk tolerances. Are you really aggressive, or are you more conservative? And you have to trade based on where your own risk tolerances are. There's no right or wrong. It's just what allows you to sleep at night, basically.
Very well. I see we are coming up at time. I still got several questions for you, and I know we have the case study consideration as well. So, as always, you just tell me.
Let's do two more, and then we'll get to that. It is an AI trade that I'm going to show. So hopefully people hang around for that, and it'll be an official idea this time. But let's do two more, and then I'll get to that.
Very well. Will says NVIDIA looking a bit shaky. Can we take a look?
Yeah, I just think that the whole space is going through a much needed consolidation. And I would agree, Will, that we're right here in an area. It is above the 10-day moving average, which we haven't seen a whole lot out of the charts today. And 200 is right here. It's a little bit of a little level of support with that big round number and the 10-day moving average hanging in there. If it can hold here around 200 and bounce, perhaps we get an extension on that wave five. The tap box is up here saying it could go lower. But if we can hold 200, then we're going to come all the way back down in this area, in all likelihood, down to the 50-day moving average is pretty much exactly where support is from the previous wave three high. So we got to keep a close eye on 200, Will.
And then SOUN for Lisa.
Soundhound. I haven't looked at that one in a while either. A lot of these stocks getting some corrections. You can see a lot of corrective activity going on in the markets. We can look and see that's broken below its 50-day moving average. Another one of the catch a falling knife scenarios. It's not quite to a 50% correction. and there is some congestion right here. The concern I would have is that's a triangle right there. And we've talked about the triangle rules. You can see the clear breakout that we had, broke out into a zigzag higher. And we're not quite to the point yet of the triangle. So even though it's a bit oversold, you might get a day or two bounce. And maybe that's as close as it gets. They don't always touch the point of the triangle, but they get awfully darn close. So maybe we get a little support here at 15 and you get one of those short bounces. But I think I need to keep an eye on that one a little bit longer. I would want to see a little more evidence that this 50%-ish correction is going to hold. We've satisfied the rule of retracing the breakout and then see if we can catch a move. So I think I would wait, let that one show us it's ready to turn back higher in something more than just maybe a one-day bounce. All right, sorry I didn't get to more questions. We'll catch up more next week. Just a lot to talk about with the earnings, and I wanted to talk about Palantir. And before I go, I don't know if this was on the list or not, Zach, but AMD reports after the close today, and here's the concern here. What are they going to say that can continue a run like that? It's not quite in the stratospheric valuations of Palantir, but that's been a heck of a move, and I think AMD is going to have to really dazzle the market to be able to turn and go higher from here. There is some congestion right through here, just above 225, kind of in the 230 area, right through there. Would not be surprised to see AMD head down there unless they just absolutely smoke their earnings report. It would be amazing. So switching over to the AI, I wanted to show you a couple of things. There's the bullish list. Here's the bearish list. If you don't have this software, you can go to hub.com. Again, you're going to have the event from the guy himself next Tuesday, a week from today. And but you can go to hub.com, get a copy of it ahead of time. If you don't have it, it's free. The LA Wave signals are free. You do have an opportunity to subscribe to these AI signals if you'd like. You'll hear more about that next week. But the software itself is free. So if you want to attend that, then go to hub.com and get it. And this is what the AI signal list looks like. It gives you a list. I wanted to show you how long the bearish list is. So we're starting to see more and more stocks showing up on the bearish side of things, which I think is interesting. But we are going to do a bullish alert, and it's going to be on Lilly. Now, it is a little bit low on the score. 75 or above is what the data scientists recommend that create the AI for Hub. I'm okay at 70. I've done plenty of alerts at a 70% score, and it's right there, 69.44. So it wasn't 69.5, so they rounded it down to 69. But you can see Eli Lilly moving up. I think this is a space that's a good defensive space. That's where money runs when the market starts to lose the high beta names. They go to the more tried and true. Eli Lilly performing really well. But check this out too, and it gives me an opportunity to show you how to draw a zigzag. So people always ask, where do you start the zigzag? You start it where the impulse starts. So we had a move down, we had two sideways days. Clearly that bar right there started an impulsive move. So you draw the A up to where that impulsive move ended, you click there, bring it back down to where the correction was, and you can see very close to 61.8 right there. And then you see 100% extension. We're almost there. But if we do get the extended C wave, which remember happens a lot in a wave 3, it happens to show up even just a little bit above where the AI target is. So the AI is saying roughly 975, where the extension for the C wave, and again, I want to make sure everybody's aware that this is the expected level here, 100%. We're there. We're a tiny bit overbought. Maybe it goes sideways for a day or two, But with these runs in these wave threes on these AI stocks, sometimes they continue vertical. So it's hard to know from that aspect. You just have to, if you want to step in, you wait for a day or two pullback and realize that it could back and fill a little bit before it goes on to its move. But if you wait and see if it's going to do that, then if it does continue vertically, you miss those moves. So that's kind of where your risk tolerance has to lie there. But I like this one. We're going to use the AI target 975 on Lilly. So that's LLY is the case study idea for this week.
Very well. I will take over the screen real quick and get that posted so everyone can see it there. And as always, we encourage you to interact whether you agree or disagree with the idea, as opposing opinions is what makes markets. If everyone agreed, there would be no transactions, no trades to take advantage of. So as Rob said, this is going to be an official idea for this week. So we'll go up to the light bulb over here on the right side at the top toolbar. We'll select new idea. And this one's going to be on LLY. And sorry, remind me again, Rob, on that target price.
975.
975. And the time frame we're looking at for that?
3 months.
3 months. So we're going a quarter out. We'll come back and make this nice and pretty with a lot more details and the chart right after this session concludes. But I will go ahead and confirm, post this idea, or publish rather. So now you can see it is available there for you to come in and interact. And again, whether you agree or disagree, we welcome you to provide those details and just be considerate, of course, of our ever-growing community. I think everyone that is already a part of this community does a great job at that, and we always love to see the growing interaction. So back over to you, Rob.
Yeah, and I'll take the screen back and just leave that on as I add a couple comments. I'd like to reiterate what Zach said. The social media aspect that comes with the software, I think is amazing. It's growing every single day. I do get notifications every time somebody else signs up. It's a great place to share ideas. And, you know, one of the ways you learn is you post an idea and you look at the other comments, and maybe not everybody agrees with you, as Zach says. That's okay. Opposing opinions are warranted and educational. Maybe somebody comes up with some sort of a thought that you haven't thought of. So it's a great way to learn as well as interact with others. And I will second that. I look through it all the time, and the people that are on it are respectful, and they just post, I disagree, and here's why, without calling each other names or saying you're crazy. You know, we don't need to do any of that stuff. We all have differing opinions. Let's respect each other's ideas and all learn from it. That's the idea, and it so far has done exactly that. So hopefully you'll play around in that social media aspect of it. I think it's fantastic. So thanks as always for spending some of your trading day with us. We'll see what AMD has in store at the end of the day, and we'll be back to talk to you soon. And